highly oversimplified model where we look at the decision-making hierarchy for various private equity participants. And we'll try to match the accountability metrics with the things that the participants can actually control. Here we have Alice. She's the treasurer or chief investment officer. She must make a lot of big decisions, and let's assume that one of them is determining what percentage of the portfolio should be allocated to private equity. Now, this is an area where opportunity cost makes a lot of sense as an accountability metric. If PME says that private equity cash flows outperform the public market, then clearly Alice allocated too little to private equity. However, if PME says that the private equity cash flows underperform the public market, then clearly Alice allocated too much to private equity. Unfortunately, that's a lose-lose for Alice or the consultants that advised Alice, but it does line up with Alice's decision-making scope. Now, what about Bob, a portfolio manager who reports to Alice? In our oversimplified model, he sources private equity funds, builds relationships with GPs, performs due diligence, and recommends opportunities to the board or investment committee. Bob has no discretion to invest in public markets, so public market opportunity cost measurements like PME tell us very little or anything about his investment acumen. Bob's job is to fill the organization's private equity allocation with better than average private equity funds, and that's how he should be judged. So to measure this, you might look at how his program or his managers compare to those of other peers, or use private equity industry benchmarks like those from Cambridge Associates to see how Bob's performance stacks up. Okay, further down the line, we have Carol, our private equity GP. Her job is defined by a 300-page document called a limited partnership agreement that she negotiated with Bob. It says that Carol must invest in complicated privately negotiated transactions with predefined size and growth characteristics operating within specified geographies and industries. That LPA specifically prohibits Carol from investing in public securities, so the PME measurement makes very little sense here. Why measure the opportunity cost of something when Carol doesn't have the opportunity to invest in it? The things that Carol does control are her target markets, entry valuations, equity structures, debt levels, and the results of whatever value creation plans she puts into place. The best way to measure these things is to use the value creation models that we have been discussing in these videos. Capital structure changes can be explained by fund ownership impact, the leverage effect, gearing, and cash flow generation. P&L changes can be explained by EBITDA growth, revenue growth, EBITDA margin expansion, gross margin expansion, and operating margin reduction. Valuation changes can be explained by multiple expansion. And these measurements will get even better as we break out how broader market forces influence them. Finally, we have David, the company CEO. He's even further removed for what's happening in the market. We'll hold him accountable for things like sales execution, operating performance, and cash management. And this is another area where value creation analysis can tell us a lot. Okay, to summarize then, when you try to line up the accountability metrics with the day-to-day decisions of the private equity participants, I think an opportunity cost measurement like PME is more applicable to participants at the top of this chart for CIOs like Alice, and maybe a portfolio manager like Bob. It's a better measurement of LP investment acumen instead of GP investment acumen. If you want to understand the drivers of company performance or GP value add, so you can assign credit or blame to a fund manager like Carol or a CEO like David, then the value creation models that we've been discussing in this series give you a much better picture of what's happening under the hood.